In this video, we are going to talk about Investing for Beginners, a step-by-step guide. So before starting this video, please like this video and subscribe to our channel for future updates. Investing can be one of the more complex concepts in personal finance, but it's also one of the key cornerstones to financial independence and wealth building. While it might seem intimidating from the alphabet soup of terms like IRAs and 401ks to keeping track of the latest market movements, understanding the basics can boost your confidence and help you feel comfortable getting started. On a high level, investing is the process of determining where you want to go on your financial journey and matching those goals to the right investments to help you get there. This includes understanding your relationship with risk and managing it over time. Once you understand what you want, you just have to jump in. You can decide to invest on your own or with the professional guidance of a financial planner. Here we discuss in detail each of the key steps to help you get started with investing. Number 1. Decide your investment goals. Before you decide to open an account and begin comparing your investment options, you should first consider your overarching goals. Are you looking to invest for the long term, or do you want your portfolio to generate income? Knowing this will narrow down the number of investment options available and simplify the investing process. Consider what your ultimate goal is for this money. Is it for retirement, a down payment on a house in the next 5 years, or something else? Says Lauren Neistrat, CFP, CFA, and Portfolio Manager at TruePoint Wealth Counsel. Understanding your goals and their timelines will help determine the amount of risk you can afford to take and which investing accounts should be prioritized. You also don't want to invest your emergency fund in a brokerage account because it's not easy to access money if you need it quickly. Plus, if you need that cash when the market is facing a downturn, you might end up losing money when you're forced to sell low. Number 2. Select investment vehicle. After determining your goals, you need to decide which investment vehicles, sometimes referred to as investing accounts, to use. Keep in mind that multiple accounts can work together to accomplish a single objective. If you're looking to take a more hands-on approach in building your portfolio, a brokerage account is the place to start. Brokerage accounts give you the ability to buy and sell stocks, mutual funds, and ETFs. They offer a lot of flexibility as there's no income limit or cap on how much you can invest and no rules about when you can withdraw the funds. The drawback is that you do not have the same tax advantages as retirement accounts. There are several financial firms that offer brokerage accounts like Charles Schwab, Fidelity, Vanguard, and TD Ameritrade. Working with a traditional brokerage usually comes with the benefits of having more account types to choose from, such as IRAs or custodial accounts for minors, and the option to speak with someone on the phone and, in some cases, in person if you have questions. Number 3. Calculate how much money you want to invest. As you decide which investment accounts you want to open, you should also consider the amount of money you'll be investing in each account type. How much you put into each account will be determined by your investment goal outlined in the first step, as well as the amount of time you have until you plan to reach that goal. This is known as the time horizon. There may also be limits on how much you can invest in certain accounts. Decide on a percentage of your income that you can dedicate to building your portfolio. The general rule of thumb for retirement goals is to invest 15% of your income each year, but if you started investing later in your career or want to retire early, you may want to consider investing a higher percentage. Keep in mind that 15% also accounts for any matches you receive from your employer. This means that you could contribute 10% of your W-2 income with a 5% match from your employer to reach a total of 15% to hit this benchmark. If you live paycheck to paycheck, 15% might seem like a crazy amount to invest. Don't panic. It's okay to start small, even just 1%. The important thing is to get started so your money will grow over time. If you decide to invest with a lump sum, it is still beneficial to continue adding to your investments regularly. Doing so gives your portfolio more opportunities to continue to grow. Number 4. Measure your risk tolerance. Risk tolerance describes the level of risk an investor is willing to take for the potential of a higher return. Your risk tolerance is one of the most important factors that will affect which assets you add to your portfolio. Before deciding on what level of portfolio risk an investor wants to target, they first need to assess the comfort level with risk or volatility, says Neistrat. Does it make them nervous to invest when they see the S&P 500 drop over 24% as it has this year? She adds, these questions are important because certain assets tend to be more volatile than others. One way to gauge your risk tolerance is to take a risk tolerance questionnaire. These are typically a short set of survey questions that will help you understand what your risk tolerance is based on the responses you select. Someone with a more conservative tolerance may have more of their portfolio in bonds and cash compared to stocks. Someone with a more aggressive tolerance may have a higher portion of their portfolio in stocks. As you are evaluating your risk tolerance, keep in mind that it is different from risk capacity. Your risk tolerance measures your willingness to accept risk for a higher return. It is essentially an estimate of how you would react emotionally to losses and volatility. Risk capacity, on the other hand, is defined as the amount of risk you're able to afford to take. Risk capacity considers the factors that impact your financial ability to take risks and would include things like job status, caretaking duties, and how much time you have to reach that goal. Because these other priorities can be capital intensive, your ability to take on risk must fit within those parameters. Number 5. Consider what kind of investor you want to be. There is no one-size-fits-all approach to investing. The type of investor you want to be is directly tied to your risk tolerance and capacity, as some strategies may require a more aggressive approach. It is also tied to your investing goals and time horizon. There are two major categories that investors fall into: short-term investing, also referred to as trading, and long-term investing. The lure of short-term investing is the potential to replace your current income with revenue made through buying and selling your investments. The drawback is it can be both difficult and risky to see profits consistently because of how quickly the market can move and how unexpected news and announcements can impact an investment in the short term. Number 6. Build your portfolio. Once you've determined your goals, assessed your willingness to take risks, decided how much money you have to invest, and what type of investor you want to be, it is finally time to build out your portfolio. Building a portfolio is the process of selecting a combination of assets that are best suited to help you reach your goals. This approach to building your portfolio allows you to view your investments through the context of what you're trying to achieve, which can be a good motivator to keep going. Your first step is to select the right type of account for the goal you're looking to accomplish. Number 7. Monitor and rebalance your portfolio over time. Once you've selected your investments, you'll want to monitor and rebalance your portfolio a few times per year because the original investments that you selected will shift because of market fluctuations. Rebalancing is the process of reallocating those funds to match your targeted allocation. A general rule of thumb is to rebalance any time your portfolio has drifted more than 5% from its initial allocation. One advantage of robo-advisors is that this rebalancing process is done for you automatically. So this is our today's video. If you like our video, don't forget to subscribe to our channel or hit the bell icon. We will meet again with another interesting topic. Till then, stay safe and stay happy.